Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Our guest for this week's show is managing partner at LBX Investments, Robert Levy. Now, LBX Investments is a diversified commercial real estate investment firm that prides themselves in their proprietary, research driven approach to identifying and investing opportunistically into mispriced assets. Now, their experience runs the gamut across a number of different property types, including but not limited to retail, multifamily, and hotels. And so, guys, without further ado, it's my honor to welcome Robert to the show. Robert, how you doing today?
I'm doing great, Kevin. Thank you for having me.
Yeah, excited to have you here. Excited to learn a little more about your business, peel back the onion a little bit, pull back the curtain. And so maybe where we can start with this, Robert, if you would, I'm going to pass the mic back to you. For those listeners that aren't familiar with you, your firm, and your background, maybe take a few minutes, kind of fill in the blanks, a little bit of the introduction. Tell us a little bit more about yourself and ultimately how you found your way into the real estate world.
Sure. So again, thank you for your time. Appreciate you inviting me here. My firm is LBX Investments, and I have a partner, Phil Block, and myself. We started the company 4 years ago. You can't see me, I don't think, on the video, but I am getting old. I've been in this business for 30 plus years. Have a pretty diverse background in kind of all areas of real estate. Spent a bunch of time on the finance side, investment banking. I ran a public company. I was the CEO and the CFO first, and then the CEO of that company called Centerline Capital Group. So I've done pretty much everything in and around real estate, and including various property types, multifamily, hotels, and retail. And so we started the company 4 years ago. We're kind of contrarian by nature.
Mhm.
And our goal was to, as Kevin in his introduction said, kind of find mispriced assets. And right now we find the retail space fascinating for that reason.
Well, I appreciate the background, and I would love for you to elaborate as to why retail, and ultimately is it a, when you say that you find it fascinating at this point in time, is it a direct result of COVID, or are there other factors as well?
It's other factors as well. I mean,
Okay.
we've been investing in retail for 6 years now,
Mhm.
4 years within LBX, and prior to that for a couple of years. So, I mean, retail is just, as we all know, it's for a lot of people a bad word, right? It is the sector that people shy away from for various reasons. We believe that the information out in the marketplace is inaccurate, and in fact, our portfolio we think supports that. Our portfolio, and we can dive more into more details on that, but our portfolio has performed great. There are certainly sectors of the retail space that are underperforming, Class B and C malls specifically, but what we own is kind of open air neighborhood community shopping centers,
Mhm.
many with grocers. And other kind of really high quality anchors like Target or the like. And that portion of the sector has performed great. But because of all the noise in the marketplace and everybody's talking about the death of retail, those are trading at significant yields in relation to other asset classes. So in our view, we can buy great real estate, great locations, the right demographics, and all those things that you want in a property at significantly higher yields than where you can buy other assets today.
That's fantastic. And so you can't just take the broad brush stroke approach to the retail apocalypse that you see as a lot of the catchy different headlines. Correct? Is that what we're saying here?
Right, exactly. And in fact, we believe the whole notion of the retail apocalypse is it's not wrong. It's just it's overstated.
Mhm.
And in fact, it's kind of interesting when you look at, and there are a bunch of public companies out there, so all this information is public.
Mhm.
But what most people hear about or read about is what you hear about in the mainstream press, right? And everybody talks about massive closings of stores, et cetera. But actually, in 2021, more stores opened than closed, and people don't understand that. And also, if you think about the supply-demand dynamics in retail, there's been no retail built in the past 10 years.
Mhm.
Meanwhile, the population continues to grow, incomes continue to grow, and in fact, a bunch of malls, stuff that we don't buy, have closed, right? So you have actually a reduction in supply, you have an increase in demand, and if you own the right real estate, like I think we do, you'll perform very well. And again, going back to the public companies, I mean, look at just open up the 10Ks of Walmart or Target or TJ Maxx or Ross Stores or Burlington, and look at their profit margins, and look at their same store sales growth over the
Hmm.
past few years. Even through the pandemic, they performed extremely well. And then on the other hand, look at the internet only retailers. The ones that are just e-commerce companies are not profitable. They can't make money because what they're figuring out is they need physical stores.
Hmm.
Why do you think Amazon is opening stores, and why do you think Warby Parker is opening stores, and other pure e-commerce companies are now realizing that they can't make money as pure e-commerce companies, so they're even opening stores, and so that's where we can really benefit.
Yeah, that's fantastic. Are there any, speaking to COVID, are there any major shifts that you've had to make in your overall investment strategy or investment thesis as a result of COVID? Are there any major changes in your business that have been made?
Not really. As I said, our portfolio performed great,
Hmm.
so we're very happy with what we've invested in. The way we view COVID, to be honest, is it was, and I think you may have heard this, and this certainly has been written about, is it was an accelerator, right? And so in a way, we view it as a positive for retail, because what it did is it got rid of the stuff that was going to fail anyway because it just
Sure.
wasn't good product, um, and the good product in the right markets, and again in the right real estate, that all performed well. So
Mhm.
it just accelerated that process, and because we own good, the right real estate, we were not negatively impacted. In fact, our collections throughout COVID were close to 100%.
Yeah.
um, and anything that was not paid was just deferred and now has been repaid in rent. So we're basically at 100% collection. And in fact, our leasing momentum today, excuse me, our leasing momentum today is better than it has been in the 6 years we've been in the business.
Wow.
So it really, and our goal is just own real good, good real estate in the right market. So it really did not change because of COVID. We're consistent.
Hmm. How about the lenders in the space? Was there a period of time over the last couple of years where they pulled back the reins a little bit as far as debt options that might have been available, or did you see not many changes at all?
Absolutely. And in fact, we had a very quiet 2020. It wasn't quiet because the world it seemed like it was falling apart, but from an acquisition perspective,
Hmm.
we did not acquire any assets in 2020, and part of that was because there was just no debt available, and part of
Hmm.
that was nothing was trading. Um, and so we looked at a bunch of different options and opportunities, but at the end of the day, we didn't acquire anything, and that went into early 2021. We did acquire two great assets at the end of 2021, which were our first acquisitions in about 2 years at that point.
Got it.
But a lot of that had to do with the debt markets, and it's the pros and cons of investing in a contrarian sector.
Hmm.
The reason why we find it attractive is because there's less capital chasing it,
Yep.
and that drives yield, right? So we can buy at elevated yields. The negative to that is that it's harder to raise capital, right?
Mhm.
So when we like a deal, the debt markets are difficult, or at least not completely open. So if we go out to 50 prospective lenders on a retail transaction, we'll get 7 term sheets or 5 term sheets. If you do
Mhm.
that in the industrial sector, you'll get
Yeah.
40
50.
term sheets, right? It will be right, exactly. So
Yeah.
that's the negative, and it's the same thing on the equity side, right? And when we raise equity for a deal, um, it's harder, right? It just makes our job harder. At the end of the day, we think that's a great place to be, and we like that, but it certainly makes our jobs more difficult. Now, Phil and I, my partner and I, we come out of the debt space. We spent many years in the debt
Hmm.
world, so we have a lot of great relationships. We borrow through kind of relationship banking type relationships, and
Yep.
that works out well for us.
Give me a general idea of what type of debt's available today for your typical grocer anchored transaction. I mean, maybe use the case study of one of the deals that you closed in 2021, if you're open minded to doing that.
Sure, absolutely. So there actually still is a decent amount of debt available. We are not high levered borrowers. We
Hmm.
typically cap out and this is our view, there are certain lenders who would lend us more, but we typically cap out somewhere between 60 and 65% loan to value. And at that level, there's a decent amount of options. There's banks, there's credit unions, there's insurance companies, life companies, and then there's the securitized space. We do not borrow in the securitized space. I come out of that world, and in my view, it's a really tough way to borrow money, and
Yes.
we just don't want to have anything to do with it. That's just our personal view. So we focus on banks and credit unions and life companies and on the relationship side. So we bought a deal in south of Chicago in a great suburb of Chicago called Evergreen Park. We bought a Whole Foods anchored center. This is back in September of 2021. We closed on it. It's a great piece of real estate in a good market. And for that one, we used a life company execution, a 10-year life company, fixed rate, about 60, I think it was like 62 or 63% loan to value. It gave us prepayment flexibility. I think it was fully prepayable after year 6 or year 7. We had IO for the entire 10 years because it was low leverage. So we can get, kind of full 10-year IO, and it was priced great. So that's a perfect execution for us. It gives us flexibility. It's fixed rate, so we're not taking any interest rate risk, which, we view, we're not smart enough to know where interest rates are going. And so we'd rather just do fixed rate and sleep at night. And so that was a great execution for us.
It was the opportunistic nature of that particular transaction. Was it just buying it right on the front end? It sounded like that was fairly a stabilized deal, especially based on what type of debt you're putting in place. There's not really a plan to recapitalize that asset in the next couple of years. And so is it just buying it right on the front end? Is that the value play on that particular
Um,
transaction?
Kind of. I mean,
Yeah.
there was some value add. There's a little bit of vacancy,
Okay.
and an ability to push some rents. It's a complicated deal, and it has a complicated tax structure. And our view was that the market was not willing to really dig into that tax structure and really understand it. We did. We actually have a relationship within Cook County. And so we were able to, we think, really understand it well and quickly. And so this is typical in the retail space. If you're bidding on a, not to, again, pick on the multifamily or industrial space, but if you're bidding on a multifamily property, you're typically bidding against 40 other people. If you're bidding in the retail world, it can be anywhere between 3 and 7 bidders, somewhere in there. And so in this instance, we don't know exactly, but it felt like there were maybe 3 real bidders, us and maybe 2 or 3 others. And we just felt that because of that, it's a larger deal. Chicago has its struggles in the media, complicated tax structure. And we think you just kind of put all that together, and there were just very few bidders. And so we bought it at an 8 cap. And this is a, Whole Foods anchored center. So, that same property in Atlanta or Austin would probably trade at a, 5 cap or 5.5 cap, somewhere in there. And so we just felt we got a great deal, and we're cash flowing at a really wonderful level. And, so we like that.
Yeah, it sounds like a great opportunity there. And so what is the long-term play, maybe more specifically to this particular deal? Based on what I saw on the website, it doesn't look like you're buying things in a fund structure. Are these one-off individual capital raises, or?
Correct.
Okay. So what is it in a situation such as this? Obviously, it's more of a long-term hold strategy, but what is the end game? Is it an exit after your prepay burns off, or do you guys intend to hold these 10 plus years? What's the overall plan
So,
look like?
so it really depends on the property, and the asset. We put together a very detailed business plan for every asset that we buy. And as you said before, every asset sits within its own LLC. We don't raise a fund. We haven't raised a fund. We have contemplated. We like the fact that we don't have capital sitting on the sideline, kind of burning a hole in our pocket, and therefore, kind of incentivizing us to be more aggressive. We like the fact that when we like a deal, we bid on it. If we win it, we'll raise the money. We always felt confident in our ability to do that. And every deal we put together a very detailed investment thesis and strategy and business plan, which we share with all of our LPs, of course, who are looking at the transaction. And we execute on that. And sometimes that's a 3-year business plan, sometimes it's a 7-year, sometimes a 10-year. Sometimes it's like a Chicago deal where it's more of just a cash flow deal, and we're buying it at a very attractive level, and we're gonna manage it really effectively, and we'll keep it full, and we'll continue to grow cash flow as rental rates continue to climb in the market, and a lot of these are kind of built into those leases, a lot of those increases. And other times, we'll do some more significant redevelopment of a property. We'll bring in new tenants. We'll boost occupancy. One of our strategies that we tend to employ is the out parcels in front of a property. We'll develop those for sale. Those can be very, very accretive to our shareholders, to our investors. Or we'll take an existing one. If we're buying a center at an 8 cap, we can sell that out parcel at a 5 cap. That's very accretive, to our investors. So there's a whole host of different strategies that we'll employ, and that we'll and we'll lay that all out for them at the beginning.
So speaking to being a contrarian investor, we're speaking to retail at present time. I know you've got some a good amount of experience in the hospitality space as well. Is that a sector that you guys are considering? Given the the challenges that space had during COVID, and even now coming out of COVID. Given I guess the location, because there's plenty of locations here in Florida where we're at where they've seemed to have been thriving for the past even year and a half, right? But plenty others across the country that are still struggling to get back to pre-COVID levels.
Yeah, it's really fascinating. So I spent a number of years of my career in the lodging space.
Mm-hmm.
I think it's a fascinating space, and we have a partner of ours who also has a kind of deep background in lodging. So when COVID hit, we got on the phone in March of 2020 in April and said, there's got to be an opportunity in the lodging space, right? Nobody's traveling, all the everything that we know, obviously, would have a direct impact on lodging, and it did. But honestly, our government did whether not to get into politics, did a heck of a job of kind of propping up businesses, right? And
Mm-hmm.
in all different ways, with interest rates and quantitative easing and all the various loans to businesses. And so we never saw the distress and that we expected. And there was like this window where we felt, and nothing really traded, right? Because nothing traded because the owners and operators were being supported by these government programs, and so there was no need for them to sell into a bad market. And so everybody just kind of held on to their real estate. There was a very short period where things started to trade, and it looked like they might trade at some discounts. And we bid on some hotels, we bid on some debt paper, and we got outbid every time. And within like a month or two, everything was back to pre-COVID pricing. And in fact, after that, went to north of pre-COVID pricing. So there was just never any distress, which we found really surprising.
I mean, that is, I mean, that's interesting in that. I mean, there's still, I would assume, I don't know how many, hotels across the country that aren't yet back to pre-COVID levels. I would assume that it's a significantly large percentage. I mean, business travelers they're not traveling, like they had pre-COVID. And so, I mean, who do you think, I guess, backtracking a little bit, the bidders on this, this paper? I mean, is this institutional capital coming in, or I mean, just other groups like yourself that are maybe a little bit more aggressive in that space? Or what are your thoughts there? I mean, just it seems as though there's still some pain there. And I know banks kind of learned some lessons after 2008, a little bit more flexible with working with borrowers as well. However, we do know you come from the securitized space. I mean, there's a good bit of CMBS securitized debt that's tied to the lodging sector. I mean,
Yep.
much less flexible debt arrangement there. is there some distress that, maybe it's just delayed, but ultimately they're going to get flushed out here in the coming next 12 months? I mean, what are your thoughts there?
I mean, maybe, and we are keeping an eye on it to
Yeah.
see if that happens. We have not seen that yet. Like, I'll give you an example. So we have a relationship with a large bank in the Southeast
Hmm.
in Georgia. And about, maybe 6 months after, so it was maybe like the fall of 20, they called us and said, hey, we're going to be coming out in the market with a portfolio of hotel loans that we're going to sell off of our book. And we'd love you guys to bid. I said, great. So they sent us the tape. We dug into it. We bid, I think we bid, it's like 78 cents on the dollar, 80 cents on the dollar. I forget exactly. And it traded at 98 cents on the dollar. So it
Oh my
basically traded
gosh.
for par.
Yeah.
So I don't know. Um, I don't know
Interesting.
where that capital is coming from. There is certainly, as we all know, a lot of capital out there, and it's institutional, it's private equity. I think it's private guys like us um, that just get more comfortable with either the risk or the growth, and are willing to buy that type of paper at low coupons.
That's just shocking to me. When we talk about retail initially, you mentioned that, when you go into any particular multifamily or, industrial deal, if there, if there's, um, you know, call it on average, each deal is maybe going to have 40 bidders, right? Whereas
Yep.
a, typical retail deal, maybe you'll have 4 to 7. I think that was that statement that you made. And I would think that it's, my guess would have been that it was, quite less, again, coming out of COVID here in the lodging sector, but it sounds like it's not at all. It sounds like there's more opportunity that you guys are ultimately finding in the retail sector that wasn't, wasn't impacted. The majority wasn't impacted as a result of COVID. And so
Right.
that's just, that's shocking to me,
It
but
it
I guess it
is
is
it
what it
is
is.
it's very surprising, but the only thing I would add to that is that we are, to be, honest, like we're very embedded in the retail world today, right?
Hmm.
Every broker knows us. We have
Yeah.
a good reputation, and we have all the infrastructure. And so part of it could be just we're seeing, because of all of that in our relationships and the relationships that our people have, we're just seeing more opportunities there, and we're seeing plenty. Like our pipeline right now is full. Yeah, we're
Hmm.
seeing a ton of stuff that we find really interesting. Just, great pieces of real estate in good markets that are trading at elevated cap rates, in our view. And so I think that's just, kind of where we're focused right now. It's just, we think it's just a good place to be.
Yeah, that's great. Are you geographically agnostic? I mean, will you guys go anywhere where the deals are?
We are. So we started focus on the Southeast for all the obvious reasons,
Hmm.
right? Great demographics, growth. We own in Orlando and Atlanta and Charlotte, Nashville, and um, Charleston, South Carolina, et cetera. So we're in all of those states, and we have a couple million square feet right now. And we love those markets.
Hmm.
We'd love to invest more. I wish we invested more. I wish we were double our size, but we're not. Um, the challenge for us is that all of a sudden everybody is interested in those locations, and so the yields have just become compressed in
Hmm.
some of those markets. And it's interesting. It's a lot of the public companies that have been the public REITs that have been investing, and they all have made public pronouncements that they are um, focused on investing in the Southeast and Southwest. So
Okay.
which is great for our current portfolio. The value of our current portfolio continues to climb, but it has made it more challenging for new stuff. And so we're definitely looking elsewhere. I mean, our view is, the REITs own great real estate in great markets,
Yeah.
and they capitalize them well, but they don't do all the small things that we do to really create value, because retail is like one of those businesses that you have to be roll up your sleeves every day to create value. And we like to buy from the REITs. So where they're selling, we're buying, and if they want to buy, we'll sell to them. That's kind of
Sure.
our view.
Talk to me about the rolling up the sleeves and adding value. Like, what are some of the, we're in the manufactured housing space, and we kind of look at it as like, easy to middle to more difficult value. And, easy value would be undervalue, under market rents. Like, we could simply go in, bring the rents to market. That's low hanging fruit in our opinion. The middle hanging fruit might be some more operational challenges that we have to clean up and fix. And then high hanging fruit would be capital intensive major capex work, us bringing in new units, which is fairly capital intensive, and so again, different business model than the retail sector. And so, give me a general idea of what those value add components are. Maybe speaking to an asset that you might purchase from a REIT that, again, they don't have as much of a hands-on approach as your group might have.
Sure. So, so this is one of the reasons why we really like retail, because there are high barriers to entry, in our view, to maybe not to get into the market, but to do well in the market, right? It's not easy. It's a business where, we work really, really hard every day to create value. Not saying that people in other sectors don't, but, I've been in the multifamily world, and if you buy a good piece of, real estate in the multifamily space, you kind of, once you're kind of done with your, refresh of the units, you kind of push rents, and I don't want to say it manages itself. It certainly doesn't, but it's less management intensive at that point. With retail, you can't do that, and that's in effect, we view that as kind of one of our advantages, is because we think we're really good at what we do on a daily basis, and we think there are others out there that are not as good as us, and we like to buy real estate from them. We want to buy retail from them. And I'll give you an example. So we bought a property in Orlando, about a mile from the University of Central Florida, which is, as you may know, it's like the second largest university in the country right now. And that area around UCF is very, very dynamic. We bought probably, one of the best pieces of retail in that submarket. It sits like on the corner that you want to be on. It has like 100,000 cars a day passing by this property. And when we bought it, it was like 72% occupied, and the average rent was $18 per square foot. Today, it is north of 90% occupied, and we're going to get close to 100% over the next few months. And our rents that we're signing leases at are around $24, $25 a foot. So, and that was a publicly traded company, so they own a great piece of real estate. But a lot of times they lease, their leasing teams are corporate, regional. Like they sit in, like the person who was leasing this property in Orlando was in Atlanta. And you just can't do that. That's just not
disconnected. They're disconnected from the local
Yeah.
marketplace there. Yeah.
Correct. It's just not how you can't do well in retail like that, in our view.
So what improvements were made to that property? Mostly cosmetic improvements to the facade and to the grounds. I mean, is that generally, what type of improvements are made to a retail center such as that in order to justify the higher rents? Did you completely switch over the tenant profile as well over the time that you've had it?
We have. So yeah, we did a nice facade renovation. Nothing, we didn't need to spend too much money, but we put some new facade work on it and painted it and put up some new landscaping and all that. And we started pushing rents, and we brought in a great kind of national salon concept, which was a great addition. We brought in some restaurants. It just like kind of slowly but surely. And we actually have not removed any existing tenants, but we told them, listen, this is not an $18 per square foot market. This is a $24 or $25 per square foot market. You can stay or not. So that has been great. And then on top of that, that property has 4 out parcels. So 4 buildings sitting on the main road. We have sold off all 4 of them at this point for significant gains, because we bought the asset at around an 8.5 cap rate, and we've been selling off those out parcels at somewhere, the low was at 4 3/4.
Wow.
And the high was around a 6.5. So it's just a great arbitrage for us, and it allowed us to pay down debt and return a lot of capital to our investors.
No, that's exciting. And you had acquired that asset, and what year was that? 2019?
That was actually 2018.
2018. Okay. Got it.
Yeah.
Fantastic. Well, I appreciate you providing some additional insights there, and really case studies of some actual deals that you guys have done. It helps us gain some real clarity as to what your business model is. So really appreciate that. And I'm going to switch gears real quick, Robert, before we wrap things up. And there's a question I always like to ask the guests that we have on the show, and you've been at this quite some time, been involved in many different sectors of real estate. And so, but I want you to look at this. I want you to look at this, or take this question from the perspective of, being in the nitty gritty and the operations side, just like you guys are in the retail space. I know you've had your hands in other different asset classes as well. And so it doesn't have to be retail related, but the question would be, there's you've been involved in a litany of transactions. Um, you know, transactions typically always exceed our expectations or might not exactly meet our expectations, right? Like, it's kind of a mixture, and ultimately a lot of times it just kind of levels itself out in the long run. But there's always that one deal that we lost more sleep over than the others, the one that added more stress to our life than what was necessary or expected. And just, just ultimately filled with challenges all the way throughout. And so when I say those things, does that trigger any deal in your memory that just seemingly was just a mountain that you just never felt like you were going to get to the top and down the other side? And if so, would you mind sharing some details of it, the challenges you faced, and ultimately how you made it through the other side?
Sure. Um, Honestly, the best example of that I can kind of immediately think of was when I was not a particular piece of real estate, but I was the CFO of this public company, um, and I was the CFO right in the downturn of 2007, 2008,
Hmm.
2009. So the global financial crisis, and the lesson learned for me was leverage. You know, kills in a downturn, right? So we were a public company. We weren't highly levered, but we certainly had leverage on the balance sheet.
Hmm.
And when 2008 hit, if we were less levered, we would have performed better. And so we spent 2 years scrambling, refinancing debt, paying down debt, selling assets to pay down debt,
Hmm.
doing all those things, and we survived. And in fact, we then thrived after that. So we did fine, but we would have done better, I think, as a company if we were not so highly levered, or not that we were highly levered, but not levered at that level. And so the lesson learned, and I bring it to and so does my partner Phil. We bring it to LBX is, sure, we could push leverage. We can go to 75%. We could probably go to 80% of some of our assets. And we've gotten those quotes, especially in the CMBS world. CMBS would love to do some of our deals, and some of the conduits out there, and they're
Yep.
willing to go to 75 or even 80% at times. And we're just not going there. Like
Mhm.
I've been there, I've done that. It is not a good place to be. There will be another downturn. There will be another moment where we all kind of look at each other and say, where is the economy going? And I just don't want to be there. And so
Yeah.
we all sleep better at night when we're at 62, 63,
Yep.
64% leverage. And that's kind of, that makes a lot of sense to us. And we invest in every deal ourselves. We're writing checks into every deal, and we
Hmm.
just all sleep much better at
Yep.
night
Yep.
at that level.
No, I agree with you. So it had similar challenges during the global financial crisis, yeah, we shared the same philosophy in our company. Our average LTV across the board is right around the 60% range. Most of the deals that we buy, we surely could push, maybe not the 80%, but probably most of them could probably get to that 75% range once stabilized. But it's just, when times aren't as good, the one thing that can ultimately kill your deal and kill your company is debt, and being over levered. It's luckily that you're able to sell off some assets. I mean, because there was a period of time there where it seemed as though everyone got cold feet. I mean, the buying
Yeah,
stopped, right? And so luckily you're
absolutely.
able to actually spin things off and right the ship. But many others didn't have that overall successful outcome on the other side of things. So in
It
any
was a
event,
rough
no,
couple of years.
it was a rough couple of years. So it was a rough couple of years. That's why I got
Yeah.
this gray streak in my hair
Yeah.
here. So,
I hear you.
but well, Rob, this has been a lot of fun. I appreciate you coming to the show. I appreciate you spending time with us here today. And for those that want to learn more about you and your group, where's the best place to find you?
The best place to go is our website, lbxinvestments.com. If they are interested just in kind of looking at our deals, or
Mhm.
kind of being on our mailing list, there's a way you can sign up right on our website. Our phone numbers are on there, so you can just reach out to us if you'd rather do that. We, as I said, we ran public companies, so our goal is to be very transparent. We put out um, great quarterly reporting, and you can see that on the website. We also put out quarterly research about the retail space and the real estate space, so you can see that. And so, yeah, we'd love to, just begin the conversation with people. And if you have any questions, feel free to reach out. My email address is also, and as is my partner Phil's on the website as well.
Fantastic. Well, Rob, thanks for coming on the show. Very much appreciated.
Thank you. Appreciate the time.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.